Hello, everybody. Welcome to November's Cup of Joe. We have our theme music back, sort of. I'm Mike Carrazzo, the content manager at Ryerson, and I'm joined as always by Nick Webb, our director of risk management, commodities hedging. Nick, how are you?
Mike, I'm doing even better now that I got that little jingle back in my life. I
Yeah,
missed it.
yeah, it's missing, right? We haven't had it for the last 2 months.
How are you doing?
I'm doing good. I'm doing good. I had to call an audible, move out of I was getting some bad internet reception at my home. So luckily one of the Ryerson 100 plus locations, one of them was right down the street for me. How about that for a plug?
You can just admit that you and your wife got in an argument.
Yeah, yeah. She's like, I don't want to hear about metals commodities anymore. Well, we got a good show today, as we always do. Nick, you're gonna do your thing. You're gonna tell us all about what's going on in the macro world, and then we are gonna bring on our senior director of logistics and our director of procurement. We're gonna talk imports. We're gonna talk freight recession. Yes, there's a freight recession going on. We want to peel back the layers, see what it means for metal, and then you'll get into your metals update and take questions as always. So
Perfect.
let's get into it.
All right. Well, before we do that, although this is a metals podcast, we have to touch back on this topic, which we highlighted last month. Last month, Mike and I touched on the idea that for the better part of 12 months, a certain football team that's local to Mike and myself, the Chicago Bears, had not won a single football game in the entire last 12 months. And they're the only professional U.S. team to have achieved that feat. Well, later that night when we recorded Cup of Joe, we got our victory, and not only one. Later in the month, we got our second victory. So I
Yeah,
expect some royalty checks coming, Mike, in my way, for first airing it on Cup of Joe and bringing that spirit alive.
you're right. That was a Thursday, and that was a Thursday night game. And I remember, I think our producer Jason Pounders texted me. He's like, "Dude, I think Nick's right. And I think we gotta take you to Vegas because you made the prediction."
They just needed that curse of mine.
Yeah, well done, well done.
As always, these are the opinions of Nick Webb, Mike Carrazzo, Elizabeth, and Jeff. These are not the opinions of Ryerson. This is not investment research, do your own research, but we think we've got some great information here this month, and let's go ahead and hop into it. So first things first, as we typically do, we like to highlight what's going on around the globe with regards to manufacturing PMIs. And I guess good or bad, it's really kind of a continuation of the same. So a lot of the trends that we've seen in the last couple months really seem to be rolling through into this month. And what I would mostly highlight is in the case of the U.S., if we just look at the S&P global number, right smack dab at 50, that's basically flat growth year over year. Nothing to get excited about. We will look at the ISM data point here in a second, which is a little softer. I do kind of dislike when the two data points deviate from one another because I don't have a great explanation as to why one would be softer than the other one by a fairly wide margin. But when we look at other regions of the world, it's a lot of mixed data. We continue to see Europe in what looks like a recession. And you can see that in the deep red territory. Those are numbers that you really haven't seen since the COVID lockdowns. But most other regions of the world are okay. And I would say that's really kind of the main theme for manufacturing right now is it's not sky is falling, it's not going gangbusters, it's just okay. Now, what I don't know is that kind of a transition into something that's going to look softer. As we've seen several years of very strong manufacturing activity, are we starting to head into more headwinds? If I'm a betting man, I probably say we are going to see a few more headwinds coming towards us into year end and next year, and we'll highlight some of those. But it's not all bad. There are certainly some bright spots out there, but that's kind of where I'll leave it for now. Is manufacturing activity per the S&P Global is okay. Now, if we flip that over to, or in contrast to, the Institute of Supply Management, they are seeing things a little softer. So PMI of 46.7, you can see up in the top left corner, month over month, that's a fairly large drop from 49 down to 46.7. And if you look all the way down in the bottom right corner, this is a theme, at least per the ISM. This is a theme that's been going on for about a year now. We're seeing a contracting manufacturing economy. Obviously, we've highlighted in past Cup of Joes the idea that the services economy for now is still in growth territory. So that is helping to offset some of this weakness. But just strictly on the manufacturing side of things, it's a bit softer. And you can see as you look at a lot of the subcomponents, whether it's employment or pricing, a lot of backlog related activity is pointing fairly negative. And I don't want to call out too many individual companies within the manufacturing space, but I think it's worth highlighting. A couple of days ago, Caterpillar announced their results for Q3, and fairly interesting data point as it relates to this, which was their earnings looked really good, their revenues looked really good, but one of their slides actually highlighted a very significant downward move in backlogs. The idea that as they look forward in, what types of lead times they have, they're looking a bit softer, and the equity, as you might expect, did sell off on that. So I think some of this data is being corroborated out in the economy from commentary from management teams within the manufacturing space. That being said, when we look at a different data point, GDP, and again, this is a little backward looking, but the GDP number came in officially at 4.9%, which, as you can see, looking back over time, 4.9% is an extremely high number. We have highlighted the fact that the consumer continues to be extremely strong, or at least through Q3 had been extremely strong. There might be some headwinds that could soften that, and we touched on those a little bit with regards to student loan repayments coming back online, a potential government shutdown, and then the autoworker strike. We'll touch back on those here in a few minutes. But no other way to say it than Q3 was an extremely strong quarter as we look at the U.S. economy. Now, taking that same set of data and rolling it forward into Q4. So this is the Atlanta Fed GDP Now Index. What it's attempting to do is give us a better real-time look at where it's forecasting GDP using whatever economic data points are coming in at that time. And it's a fair amount softer. Currently, we're looking at a Q4 number just north of 1%. Again, that's not a terrible situation. It's certainly not reflective of a recession at this stage. It's still suggestive of growth. And that's even in the face of some of those potholes that we talked about last month, being the auto worker strike, student loan payments coming back into play. So it's still okay, and it is still growth. So nothing to really hit the alarm bells over just yet.
Hey Nick, that's a big gap, right? So the first number you showed was 4.9. Is that right?
Yeah, that's right.
What was that? That's the national, and then the Atlanta Fed is 1.2. I guess. Why such a big gap between the two?
Yeah, I really do think it is. So it's a great segue into this slide here, which is, as we've talked about, there were a number of factors, and all of these factors do have some sort of impact on GDP and on growth in general. And that would be the resumption of student loan payments, which went back into effect, and it is still in effect as of October. Goldman Sachs estimates that impact to the economy is a little over 0.5% just in and of itself. Now, the other two items are a little more up in the air. The one on the far right, which is the United Auto Workers strike, as we sit here today, that has successfully been pushed off the table, and they've gotten a resolution on that. Granted, it comes with fairly large pay increases for the unions, but in terms of its impact on hurting auto demand or auto production or any of the tangential jobs related to that, that risk is now being pushed to the side. It did last for several weeks, so it is worth noting that as Goldman shows here, for every week that the strike lasted, that's going to impact GDP and the economy in general. And we did have that going on for about this amount of time. So call that another 0.5% to 1% that will be knocked off from Q3 to Q4. The one that we don't know about is in the middle, the government shutdown. I can't remember exactly where we were sitting this time last month, but in the last 30, 45 days, we did get a Speaker of the House, which at least to some degree may help to create a little more cooperation within the government, or that's the hope. But as we roll through the month of November, come like the 15th or 16th, I think it is, we may be bumping into another situation where we could see risk of a government shutdown. And again, Goldman highlights this risk that, again, cumulatively, there will be another roughly 0.5% that could take place to GDP. So a lot of these things are the elements that are creating headwinds. And I think you've got the broader picture, which is the Fed continues to be restrictive. Interest rates continue to be elevated. Granted, they aren't going up every single month as they had been for a long period of time, but they are elevated and plateauing at a fairly high clip. So that is all in an intention to cool off the economy, and it looks like it's beginning to feed in a bit as we look at Q4 numbers.
And I guess for the point, like, is the Atlanta Fed number more accurate than the national, or like why? I guess why that one? I know there's a few others too, but is Atlanta's kind of the
Yeah,
one
so it's the reason why I like to use it, why my team likes to use it, is because it's really kind of an intra-quarter look at where GDP is tracking based on real-time data. So every time a new data point comes out that feeds into their model, they're able to update that number, so we get a better real-time look at where GDP is tracking. And admittedly, back in Q3, the Atlanta Fed number did a much better job than where bank analysts and really any other economists out there was forecasting, and it was substantially higher. I think a lot of people were expecting that number, including myself, to creep its way back towards 3.5%, and it never really did, and that's where the GDP number came in. The issue with GDP, in my opinion, is twofold. One is it tends to be very retroactive looking. So just in the last 2 weeks, did we get a Q3 GDP number? So it's already way back in time already. We're already looking forward to Q4 and into 2024. The other issue with the official GDP number is it gets revised 3 times typically. So we got the first revision of it. We're going to get another one in about 20 days, and we'll get another one in about 40 to 50 days. And by that point, you're kind of saying, why are we still talking about Q3? So that's really the main reason why we use the Atlanta Fed number, just because even if it's not perfect, it's at least more real time, something that we can use in present day.
Yeah, that makes sense. Okay.
Now, we talked about the auto workers strike getting resolved. What's interesting is some of the data points and some of the commentary coming from the automotive side of things actually looks a little more optimistic with regards to steel demand. Now, 15.5 million units annualized. It's not a gangbusters number, but it certainly doesn't look the way I would have expected auto sales to look in the face of a, let's call it 7 or 8 week auto worker strike. Ford actually came out and said that they only had about 80,000 units get impacted. And for those who want to translate that into steel demand, for every car, essentially, you've got 1 ton of steel. So if it's 80,000 cars, let's estimate round numbers, that's about 80,000 tons of steel. That's not a real big number in the face of something that we thought was going to be very, very impactful to the steel industry. So I think that's a bit of good news from the demand side, is that while auto production was impacted a little bit, the numbers, at least in my opinion, came in much smaller than I would have expected. Inflation, one of the good things about having a slightly slower economy and having some of these potholes out there is that it is actually feeding through into slightly lower inflationary numbers. So what we're looking at here is the white line is going to be the headline CPI, so the consumer price index. The PPI is going to be the producer price index. And then the orange line is your PCE. So that's going to be your consumption expenditures at the personal level. And all 3 of them, as you can see, are generally coming down. There has been a little bit of a tick up in the PPI, and I don't want to spend too much time on this, but the reason for that mainly is because of what's called base effects. Essentially, what the idea there is, if you were wound 1 year ago from June to June of 2022, June of 2022 is the peak on this chart. And so when you have a year-over-year comp, it was just very easy to beat that comp because last year was so high. So we have seen that correct a little bit. But long story short, inflation is coming back down towards the target of the Fed. We're not quite there yet. And we got a little bit of commentary from Jay Powell just yesterday, where he said work is not done. Rates are going to remain elevated. Not a whole lot of commentary about further hikes just yet, although that risk is still on the table if we see inflation perk back up. But it's going to be a somewhat restrictive economy when we think about the cost of money, the cost to borrow, and the cost to do business generally. And then on the employment front, certainly want to touch on this because this is really the shoe that we have not seen drop at this point. And so you've got all these talking heads talking about recession coming in, employment being at 3.8% 2 months in a row. It's not yet trending in the direction that would suggest that we're in recessionary territory. We're obviously keeping a very close eye on this because it could very well move that way as inflation, or I apologize, as interest rates begin to seep into layoffs and job losses and things like that. But we're just not seeing it in the data at this stage. So it's in general, I would really just say that the overall macro front is okay. Okay, maybe it's cloudy with a chance of meatballs. We haven't seen the meatballs yet, but that's really kind of where we're seeing things at the moment. With that said, I want to kick it over to Mike and our two esteemed colleagues, Elizabeth and Jeff Pence, to cover things on the logistical front.
Yeah, no, great segue there. So as we mentioned at the top of the show, we're gonna have a little bit of discussion here on some things that are going on in the marketplace. So first, let me introduce our panel. We have Elizabeth Efta. She's our Senior Director of Logistics. Hello, Elizabeth.
Hey, great to be here, Mike.
And Jeff Pence, who's our Director, International Procurement and Recyclables. Jeff, I think this is your third Cup of Joe appearance.
It is the third time, yeah, and thanks for having me back again.
And just to keep the scoreboard going, this is number 2 for you, right, Elizabeth?
Yes, healthy competition, you guys.
Great.
Somebody get this crew a coffee mug.
Yeah. We talked about maybe a jacket or something, but you got a number 4. So, but welcome. So, there's been some stuff going on with the import market, with freight demand, and what actually triggered this is we read an article about a freight recession, and said, Nick, maybe this is a good topic that we should be talking about. And we said, what better time to do it than on here. So I think that's our first question, and that would be to you, Elizabeth, is, from how I understand it, and correct me if I'm wrong, as a freight recession is that there's low freight demand over consecutive quarters. And I don't know how many quarters that is, maybe but tell us what a freight recession is, and are we in one?
Yeah, so I mean, this has been a hot news topic for the last, I'd say, couple months. We saw some really large bankruptcies in the freight market over the last year or so. YRC, Yellow Freight, finally succumbed to bankruptcy at the end of July. There have been some kind of hot up-and-coming brokers who have also folded this year in the last few months, Convoy being one of them. So really, what we're seeing in the freight market, and we started to see it late Q1, early Q2, was rates were really bottoming out. Now, that was in comparison to where we were in 21 and 22 when the market was really tight and we were kind of right-sizing things after the pandemic with getting inventory levels in the right place. And that was some of what we talked about last time I was here. But now companies have kind of right-sized where their goods are, where they need things to be. There's still some supply chain wonkiness, but for the most part, everything's where it needs to be. So demand has really plummeted. When we think about both rates and then load to truck ratios, which means the number of loads that are available for the number of trucks. So what's happening is that means that we bought up a bunch of equipment when the market was really high and people were taking containers and things for a ridiculous amount of money to go 35 miles. People bought equipment, and now that demand has gone away, they need capacity to fill it. So they're buying capacity. And sometimes they're doing that actually at an operational loss. So if you think about it, trucking's a pretty simple business model. You've got equipment and the driver. So you've got labor and capital. Those things are fixed, and they're trying to fill it and utilize their assets as best they can. And lots of people have been operating at a loss. Now, for the most part, that's over-the-road truckers, people who are going out, moving things from the coasts into an inland market, over-the-road type people who are not home every night. For folks like Ryerson or other metal distributors, we have our own fleet. We're delivering our metal on our trucks with a dedicated fleet. So we're still paying for those assets, that capital, and those drivers. Our costs haven't changed, but maybe people that are bringing material in town or moving it longer distances to customers in a full truckload, that's where they're operating at a loss, and that's not sustainable. As fuel's going up, it's becoming even less sustainable because diesel costs are going up and there's a lot of uncertainty, right? So the cost of oil has gone down slightly in the last few weeks, but with all of the turmoil in the Middle East and the Ukraine, who knows what's going to happen with capacity. OPEC signaling that they're going to be cutting production of converting oil to fuel. So that means the cost of operating is continuing to go up. Assets are going up, trucks cost more, trailers cost more, inflation, wages need to rise, but rates are staying low, and that's not sustainable. So we're going to start to see more people exiting the market and probably some more bankruptcies into Q1. I don't know if that helped or answered your question, Mike, but hopefully it did.
Yeah, so I'm curious.
Absolutely.
I think the number in the case of Yellow, I want to say they had something like 30,000 employees. Did we see any impact to the driver market or even to the equipment market of an influx of large supply of either people or equipment looking for homes?
Yeah, so part of that bankruptcy is some of the plant assets. So the actual property is being sold off. There's a number of players that are trying to purchase that. Same thing with those employees. They mainly got consumed into other LTL companies who are just consuming that volume. So there are certainly blips and things in the market, but most of those drivers were those drivers who leave from a terminal, go out, make their deliveries, make pickups, and then come back to the terminal. So they were looking for the same type of business model. So they went to other LTL companies or to Amazon or other people that are doing jobs where you're home at night, as opposed to those over the road. So there was some just quick absorption of that into other people, and the volume quickly went away. It was actually less of a disruption than I think most people thought it was going to be. Interestingly, I feel like what was more of a disruption was this cyber attack with Estes a couple of weeks ago, which put them out of business for a week. They were under some ransomware, and that had a bigger impact because people weren't forecasting that to happen. It was unpredictable.
Interesting.
And one of the notes you said there, Elizabeth, is, the freight moving one of those from the coast to inland. And that's where we bring Jeff into the discussion here. I mean, Jeff, on that, does this have how does it play into the import market, if at all?
Yeah, I think the rising fuel cost is obviously a huge factor on import. But I will say, overall rates have pretty much returned to pre-pandemic levels. The big challenge for us moving international freight seems to be the availability of carriers. Now there's lots of carriers. They're fighting for space. But what's happening and what we've seen on occasion is that they don't make every port call that they've scheduled. So sometimes if there isn't enough to pull into a designated port, they just say, we're dropping it off at the next one. Your stuff's over here. And we've experienced that, and then you have to find a truck to haul it back and add additional expense. But there's also other factors contributing to the import freight market. The Panama Canal, for example, still has excessively low water levels. I was reading somewhere that they lose something equivalent to 400 Olympic swimming pools a day through the sun and the wind, and they're below they're 7 feet below their expected low this year. And they are anticipating that that's going to continue into 2024. In some cases, they actually unload cargo so that the boat doesn't sit as low in the water so that it can pass through it. And of course, they've added surcharges to goods flowing through.
Like they've reduced the number of vessels that can go through on a daily basis, reduced the weight that can go through them. I actually saw a stat, I believe it was yesterday, Argus, which is a research company. They came out and said that to get an LNG, which is liquefied natural gas permit, to be shipped through the channel, about 6 months ago, the cost for that permit was $30,000. And today that permit is close to $1 million now. So there is some weird, funky logistical inflation going on, even though we're not seeing it just solely in local transportation costs.
Absolutely. And, one of my favorite topics we've touched on previous Cup of Joes are these creative surcharges that the shipping lines come out with. And I saw a new one a couple weeks ago, and it had to deal with the conflict in the Middle East, and it's called a war risk surcharge.
Wow.
And it's for anything in that region. And they've stopped anything that's considered a dangerous good. So your LNG, chances are, isn't even going through. I think Zim is the only carrier right now that's doing anything related to dangerous goods in the region.
So Jeff, I'm curious, I'm going to put you on the spot. We hadn't discussed this prior, but from the Middle East region, we've talked at length in prior couple of Joes about, the Russia-Ukraine conflict. Obviously what's going on in the Middle East is a little more fresh. In terms of metals specific, do we see any real direct impact to metals availability or metals pricing from that region?
I don't see any impact right away to availability. What I will say is that it has an indirect impact because Turkey is a major buyer of scrap for the US market. And one of their main export markets is Israel. So they're not buying scrap. They also had that devastating earthquake at the beginning of the year. That actually impacted scrap as well because there was so much rebar and metal being pulled out of the rubble and remelted that there wasn't a need to go outside to secure new scrap. So one thing definitely affects another. It's so globally connected nowadays.
In terms of the freight recession, back to that, so we've seen this before, right? I think last one I saw 2008, and like, is there any data like I guess what I'm getting at is like, does this like, it's like a precursor to any kind of impact on the economy in general? Did the last freight recession have any impact that, maybe we're saying looking forward, this might have an impact? I guess, how's it different or similar to the previous?
So I would say freight is very cyclical, just kind of like any other commodity, right? So freight is definitely a leading indicator in terms of what's going on with the macroeconomy. So when freight rates are declining and there's more capacity and less demand, that's generally a leading indicator that the economy is slowing, because logistics is moving goods around. So durable goods need to be delivered. So as demand goes down, freight rates go down because people are trying to fill that capacity. So it is always a leading indicator. And then as the market and economy start to pick up, rates tend to get higher, capacity starts to get tighter. And so it is a little bit the canary in the coal mine of what is coming. It's certainly not the canary, but it is one of them, and it's something to watch. So as I said, like, people are operating at a loss right now, which is not sustainable, and they've been operating at a loss since at least sometime in Q2. So at some point that's going to have to switch, whether that's people exiting or we'll see continued consolidation in the market, however that works. But rates are going to have to start to go back up. And hopefully that also coincides with some positive news about the economy.
So while we have you here, Jeff, there's another import topic that we wanted to get to, and that was there's been, I believe it was early last month, a petition filed by U.S. extruders of aluminum, petitioning for anti-dumping countervailing duties against 15 countries. Could you shed a little bit of light on that? What's the what is the story there, and kind of what's the latest?
Yeah, so I think it was October 4th. There was this investigation launched in terms of looking into 15 countries, China, Colombia, Dominican Republic, Ecuador, Indonesia, Italy, Malaysia, Mexico, South Korea, Taiwan, Thailand, Turkey, United Arab Emirates, and Vietnam, about dumping.
Wow. Are you reading that, or did you memorize?
Oh, totally memorized, completely memorized. The advantage of two screens. But no, seriously, like it's the same old story. It's the domestic extruders getting together and saying, hey, we're being harmed by material coming in from these countries. We'd like you to look at it. The investigation is launched. Now, I did read I was expecting the preliminary results for November 20th that were coming along. I did actually read something that on October 25th, the preliminary rates have already been established, and they range anywhere from 25 to 376% anti-dumping that they believe is in place. China winning the race there with a 367%. But there are a number of dates that are going to kick in. As I mentioned, the preliminary determinations are November 20th. That's for the anti-dumping and the countervailing, and then Commerce has to determine their penalties by March 12th on the anti-dumping and December 28th on the countervailing duties. So there's going to be some key dates to watch for over the coming months. But usually when one of these cases is announced, it has an immediate impact on the amount of incoming material from those countries that are named. So initially you expect, okay, if something has been ordered and they have let's just say they have a 6 week to 8 week production lead time, 6 to 8 weeks after the investigation is announced, you'll start to see a decline in material coming in from those countries. Usually what it is a bit of a support to pricing on the domestic front because there's less competition coming in as a result.
Yeah, I was going to point that out as well, which may be obvious, but if something is to go into effect, and it depends on the details of what those rates look like, but likely would be supportive of both conversions as well as Midwest premiums. Both would likely be impacted if something were to go in place.
Yep.
This is strictly extruded aluminum, correct?
It is correct.
Regardless of form. Yep.
I think it's limited to 1, 3, and 6 series alloys. So the majority of the extrusions that we tend to see are 6061 or 6063, and that fits right into this investigation.
Gotcha. Okay, great. So Jeff, Elizabeth, this is good, but let's if you stick around, if you could, we'll take some questions from the audience. Sure. But we'll let Nick get into his metals overview, and then let's answer a few questions.
Let's do it. All right, so steel just couldn't stay calm for long. We had been seeing several months of U.S. steel prices, as shown here in the white line. That's U.S. prices. Blue line is Europe. Orange line is China. We had been seeing a pretty distinct convergence in all three markets, and it was mostly to the downside for the last several months. Well, that story is now over, and we're now seeing domestic prices jump pretty rapidly and pretty robustly. And it doesn't look like a whole lot because of what we've been through in the last couple of years, but make no mistake, that's about $150, $200 worth of price moves just in the last couple of weeks. And we'll dive into some of the factors that are causing that. But that being said, looking at futures and basically what the market is saying or where they think prices may be going, blue line is where the U.S. hot rolled coil futures curve was as of a month ago. The green line is just 1 week ago, and the orange line is where we are today. And you can see that very quickly we've gotten into this situation where the December futures contract and the January 2024 futures contract are now right up near $1,000. And if I didn't say this, I meant to say this, but last month I probably would have said something along the lines of, I don't see any real fundamental reason why steel prices need to go to $1,000. Well, the market disagrees with me, which is totally fine when that happens. I will readily admit when I'm wrong. But I still generally stand by that idea, which is fundamentally, I wouldn't say there's much going on in the economy that would be suggestive of prices going up and staying at these price levels. That being said, I do think there is a very fundamental and somewhat straightforward way to explain how we're getting into this situation, or how we're getting into the situation that traders are expecting to happen, which would be prices continue higher by several $100s. So I think it's a combination of a couple factors. One, we've got Jeff Penns on the line, and hopefully he can corroborate this comment. But really, for the last, let's say 3, 4, 5 months, when we go out, we as Ryerson or any of our competitors or anybody who has access to the import market, carbon sheet prices really weren't all that attractive. And not only were they not attractive, there was also the factor that domestic prices were coming down every single month we looked at the market. And anytime you're in that downward cycle of prices, as an importer, and again, I don't want to put words in Jeff's mouth, but as somebody who's contemplating making an import buy, not only does the pricing have to make sense, the lead time has to make sense as well. And if you're in a downward price cycle, if you're going to bring something in, you have to kind of have an insight of where prices are going to be, let's say 4, 5, 6 months down the line. And up until very recently, it didn't really look like a great risk reward to do something. So that's a long way of saying I think imports have been subdued over the last several months. So that's kept things a little tighter. I noted the fact that the auto production numbers actually look a little more encouraging, despite the fact that there were some rolling strikes at a number of these facilities. So that kept the demand side of the equation a little better than what I think some expected. And then you have this factor of a lot of planned maintenance that basically got brought forward. There was a fire that we had noted on a prior cup of Joe. And the maintenance outages were meaningful enough to really kind of balance out supply demand conditions, despite the fact that there was this strike going on. And I think you have this final factor, which was we started to get down into price levels. And when I say price levels ranging in, let's say, the 625 to 650 area per the CRU, where it actually probably did make some sense for either service centers or end users to go out and say, if I'm going to make a strategic buy and buy a little bit more because prices look good, that's probably around the price range where I think some end users did do that. And that helps to push out lead times, give the mills confidence that they can begin raising prices. And, leave it to the steel industry to go a little overboard with some of these themes. But because, again, do I think that all justifies a 50% price move? No, but could we see it for a short period of time? Absolutely. And we've certainly seen it in prior cycles. And whether we like it or not, it's looking a whole lot like the end of this year and going into early next year is beginning to rhyme a whole lot with last year, where we saw a large run up in steel prices, a real lack of availability. The mills got away with a lot of rounds of price hikes, and then it all kind of reversed and slowly crept out of the market over the course of the year. And you can see the futures market, at least as a snapshot as of today, is kind of saying they're predicting the same thing. Doesn't mean it's right, doesn't mean it's going to happen. But if we took a snapshot as of right now, the expectation is a very similar story to what we saw in 2023. This is just a visual evidence of what I talked about with regards to the mills taking production offline. A lot of that was related to maintenance outages. It just happened to coincidentally sync up with the auto worker strike, but give the mills credit. They did a good job of balancing supply demand conditions in the face of what could have been a pretty ugly situation for steel demand. And when I say, there isn't really a fundamental reason why steel prices need to go to 1,000, this is one of the other items I'll touch on. And we actually will touch on cost curves for aluminum and for nickel here in a few minutes. But what this is doing, I know we've looked at this in the past, the yellow line is basically your implied value or fair market value of where steel prices are. And that's just a simple math equation of taking the scrap price, so the busheling scrap futures, looking over the next several months, adding $250. What's $250? That's basically the margin to which an electric arc furnace would be comfortable selling steel. It's just an approximation, but at least gives you an idea of kind of where a mill might be open or willing to sell steel. And it's a fair amount lower than where steel futures are, which is the white line. You can see we're now several $100s above where the EAFs would be able to, happily make money. And again, this isn't to call out the mills for being greedy or anything like that. But, I think I touched on a couple of the key ways or the couple of the key reasons to how we're getting into this situation of what I'll say is temporary tightness in steel. And it could last, don't get me wrong. But from a cost perspective, there isn't really a cost support element to this equation. We've talked a lot in the last couple of months about plate prices. And what's interesting is plate is finally beginning to go the opposite direction of carbon sheet. And they're actually beginning to converge somewhat rapidly, where you have sheet prices actually experiencing this fairly robust rally. And on the flip side, almost simultaneously, you're seeing prices decrease on the plate side, and so much so that there was actually a public announcement from, I believe it was Nucor last week,
Yep.
for a price decrease, which for anybody who's been in the carbon space for any period of time, it's very rare for a steel mill to announce price decreases. It's very, very common for them to announce the increases. Usually it's a quiet, slow bleed lower on the decrease side. But you can see very, very evidently in the last couple of months, we have seen plate prices come back down to earth. Now, I don't want to say that the gentleman we had on from Nucor on one of our podcasts today, he was wrong. He certainly was right in saying the plate prices held up and stayed higher for a much longer period of time. One thing that was said, though, was that plate is a very different market. It's got its own structure and its own pricing. What I would point out, though, is prior to 2020, even though they are different products, even though they slightly go into different markets, there is a real historical example of plate prices and coil prices actually having a fairly strong correlation and actually syncing up fairly similarly in terms of price. It's only very recently that we saw this gap get as large or anywhere near as large as what it did in the last couple of months. And my gut kind of says that this is beginning to correct, and we'll continue to see it correct as we roll into 2024. One of the key items that I think is leading to some of the weakness is we're seeing some struggles within the wind farm sector and the wind farm industry, both in Europe and in the United States. Tends to be or had been a very big driver of plate consumption for the towers. And it's looking like some of those businesses, similar to what Elizabeth said on the trucking side, some of those businesses are finding that higher rates are making it a little more difficult to operate in this environment. We are beginning to see maybe not bankruptcies, but certainly some difficult financial conditions for some of these wind farm and solar farm operators.
Hey, Nick, I got a general question, right? So you had mentioned it too, like, so over the past, we'll call month and a half, there's been price increases announced separately, right? From Nucor, from Cliffs, US Steel. Like, do they all tend to be at the same rate, or like what's the, I guess, does one kind of lead the other? And if one does it, do the others kind of, I guess, how just kind of as an outsider perspective, do they all kind of go up together, or is it did one kind of lead the other? If that makes sense.
I probably have to be a little careful on how I answer this question, but yes, the short answer is yes, absolutely. They tend to come in a cycle. They tend to be widespread, particularly when if one goes into place and it doesn't get backlash from the industry, very quickly you'll see others pile on and do the same thing. There is always that chance that somebody tries to hike it one last step too far and it falls on its face, and then nobody else ends up following suit. But yeah, it's becoming an ever shrinking industry in terms of the number of players who can announce price hikes and have a real impact on the market. And so the ability for all of them to kind of jump into the pool at the same time is getting easier and easier. And what that tends to mean is we're seeing a lot more of these robust cycles to the upside when they announce these hikes and lead times push out. And it seems like we're seeing large cycles in the opposite direction as well when they unwind and production begins to catch back up.
And maybe you'll get to this in the next slide, but what is that doing to lead times right now? Are we seeing them pushed out pretty far? Or?
Yeah, they're pushed out right now, and I don't have a slide on it, but they are pushed out. And again, as I said, they're just 2 months ago, we saw prices down near $600 on hot roll, and we hadn't seen those types of price levels in a long time. That's kind of pre-COVID type pricing. And if you compare that to like where scrap was, the margins were pretty tight at the steel mills. So I think there was a real legitimate reason why buyers and users saw that as a price to kind of pile in and make some bigger purchases. So that helped to push lead times out pretty substantially. We're certainly seeing delays on the mill side with regards to getting product shipped out on time. So I think that's further increasing this issue with availability. So yeah, I think those two factors are absolutely playing a role.
Mm-hmm. That's it.
Now, on the aluminum side, it really is kind of a tale of three different markets. On the carbon side, we're seeing things rip higher very, very quickly. There's almost a little bit of a panic buy, if you will, heading into year end. The aluminum side sits more in the middle ground where it looks okay. We're seeing a little bit of optimism in the space, and justifiably so, I would say. And then I'll get to nickel here in a minute, but the nickel market and stainless market just looks like the laggard in all three, and certainly the weakest with regards to prices. But on the aluminum side, again, I've drawn in this horizontal line, which is sitting right in the mid 90 cent per pound range. So this is the London Metal Exchange aluminum ingot price. That horizontal white line is really, and has been, acting as a level of support for LME prices, which is really the global benchmark for aluminum ingot. And you can see we're beginning to bounce a little bit off that and building a little bit of momentum. I would say a lot of that's centered around a couple things. One is within China, despite the fact that their property sector looks very, very weak, there are other aspects of their economy, namely renewables demand, technological infrastructure that they're putting in place, power infrastructure that they're putting in place, that is consuming a large quantity of both aluminum and copper. So the demand numbers are actually running right around 3 or 4% growth within China. And that's all in the face of a very weak property sector, as I mentioned. So I think that's giving a little bit of optimism in the space. The other one more recently that we got a headline of, which is as we head into November, December for China, that tends to be drought season. And a lot of the aluminum that's produced within China is coming from hydroelectric power plants. And so what they've done is they've actually, just in the last couple of days, they announced that they were going to curtail production coming out of the Yunnan province, which is where a lot of this hydroelectric power is centered, all in an effort to kind of conserve energy, conserve power, and conserve those plants. So that's impacting the production side of things. And as many on this podcast know, China, when they make a move into either the demand side or the production side, being 50 to 60% of the aluminum market, they tend to make a splash when they make a move. And so despite the fact that, as we mentioned at the very beginning of this podcast, Europe looks like it's in a recession, US looks a little squishy. Despite all that, it still looks okay within the aluminum space with regards to pricing. Now, as I mentioned, I'm going to jump into the cost curves real quick, and this is why I think they matter. As I mentioned, I drew in this horizontal white line, which is acting as a support level for prices, and it's not just purely hocus pocus. It's similar to what we talked about on steel, where you have the price of scrap, and then there's some margin that a mill is willing to live with. It's similar within the aluminum world, where there is a price where certain producers will say, no mas, I can't make money anymore. I have to shut down my facility. Well, the red line is basically where we are today. And the line behind it is a cost curve. So I'll walk through real quickly what that is for anybody who's new to this. The bottom line, the x-axis, is going to be the number of thousands of tons that's being produced globally. So that's going to be 70 million tons. And I apologize, that's 70,000 tons, it's not in thousands, 70,000 tons. The left line is going to be the price at which their cost sits. So the cost to produce that next level or that next ton of aluminum ingot. So what it's saying is the more and more people who need aluminum, the more and more high cost providers of that aluminum can come to the market and produce it and sell it into the marketplace. What's interesting about aluminum is the cost curve tends to be very, very flat, which means at a certain price level, if you drop below that, very quickly, a large percentage of the industry becomes unprofitable. And what happens when they become unprofitable? Well, at some point, they stop making that next pound of aluminum. When we look at where those cost curves sit, so the 75th percentile, which in other words means 25% of the market is not making money, that sits at 93 cents per pound, which again, if you refer back to this prior chart, that's basically where the market is saying the support level is. So that's kind of the market saying, if prices keep going lower and lower and lower into the low 90s or high 80-cent range, there are going to be a lot of producers who won't be making money. And based on all of that, the market is finding support around these types of price levels. So that's not to say that we can't go below those price levels, but given where things like alumina pricing, bauxite pricing, natural gas pricing all sits today, we are fairly close to the cost levels of many aluminum smelters around the globe. Does that all make sense, Mike? I hope I didn't badger that one.
No, I think I followed as much as I could. Put it like that. As best of my ability.
Perfect.
Yes.
So that is one of the big reasons, in my opinion, why we're seeing cost support in the price of aluminum ingot. That's really the main takeaway, is because there is a real fundamental reason why production would come offline if we kept going lower.
Yeah, it feels like there's some support for it right now.
Yeah, that's right.
Yep.
No, on the premium side, very quickly, I'll breeze through this, but premiums are basically sitting either side of 20 cents. They're just south of that right now, and not a whole lot of action happening within that world. What I do want to note, this is kind of transitioning into the nickel and stainless section. This top portion, what I've highlighted here, is basically the forecasted supply demand balances for the next 2 to 3 years. The top portion is going to be aluminum, the bottom section, and I've highlighted the balance at the very bottom of each table. Basically what this is saying is, and this is from JP Morgan, different banks have different forecasts, but what it's basically saying is, if we assume production is somewhere around 70,000 metric, or 70 million metric tons, it is in thousands, I sincerely apologize, then the surplus that would be expected over the next 2 to 3 years is somewhere around 300,000 tons, which is actually a pretty balanced market. So I would say in the aluminum space, it actually looks like it's fairly well balanced from a supply demand standpoint, using these forecasts as a proxy. When we look down at the nickel side of things, and we assume refined production of, let's say, 3.5 million tons all the way up to 4 million tons, there's an expected surplus that's pretty sizable for the next 3 years. And you can see that just comparing it to the prior years where we've had a number of years of deficit. We're now expecting to see, as Indonesia continues to ramp up its class 1 nickel, there's an expectation that's going to feed into surpluses of class 1 and class 2 nickel, which ultimately will or could weigh on prices if that's how it plays out. I think the one real linchpin in all of these forecasts is what Indonesia does. If we continue to see nickel prices go down, there could be a price level to which Indonesia might say, hey, we need to start rationing production because we're kind of flooding the market with too much material. So that's the main headline that I keep my eye on. Otherwise, if we assume these forecasts are accurate, if we assume Indonesia continues to ramp up its class 1 nickel production, we're going to have a lot of nickel for the next couple of years as we continue to ramp up into maybe an electric-based vehicle future. And you can see it visually here in this chart. This is a 5-year chart of the LME nickel price. And it's really just been a multi-year unwind of that big short squeeze. And I think for many of our customers, it's going to be a very welcome thing. But in terms of, where do we ultimately hit bottom? Where does it stop? The nickel market is a little different than the aluminum market in the sense that the cost curve isn't quite as flat, meaning you could have decent sized moves in the price of nickel and you still have a lot of producers who are still making money. And you can kind of see that in the slope of this line right here in the middle of the chart. What it's basically saying is, even though right now where we're sitting at right on, let's say it's $8 per pound, we're right around the level whereby 25% of nickel producers are not making money. I think the issue is there's so much new nickel supply coming online that's coming online at a very cheap rate that this supply is actually weighing things down further to the left-hand side on the cost curve, and it's allowing nickel prices to find a new bottom. And that new bottom could be as low as $6 to $6.50 if we really dig into the cost curve. And it's really because of the shape of this cost curve that allows the pricing sensitivity to be so severe relative to supply demand conditions. Again, very wordy way of saying it looks like, unfortunately, the downside move for nickel prices could be a ways away, even still, despite the fact that we've seen nickel prices under a whole lot of pressure in the last couple of months.
Okay, yeah. So if I'm reading that right, so then like the nickel price going up, that bottom line is that 50% where there would be.
That's right. Yeah, and we have seen that in prior cycles. If we were wound back to like 2017, probably 15 to 17, we would fairly consistently see prices that were $4.50 a pound, $5 a pound. And at that point in time, it was truly the case that nearly half of the market was underwater in terms of their production levels. So it may be unlikely. We may have to have a recession in order to get down to those types of prices, but they're certainly within reason if you get a real slowdown on the demand side. The demand side, and one thing I would add to all this is with the auto worker strike. One of the things that came out of that resolution was both Ford and GM announced that they were going to curtail their investments into the EV space. So basically, several $1 billion are essentially that were earmarked for EV growth is now kind of being taken off the table because that money in essence is getting spent elsewhere on labor. That really does put a dent in the story, at least in the short term, for the growth of EVs within North America and potentially globally, if that's a real theme that takes place. So I would expect that to weigh on nickel prices, lithium prices, basically anything that goes into the battery space with regards to EVs. So it's a little bit of a dent in the story with regards to that development.
And further complicates the supply story too, right? Because that leaves extra supply.
Yeah, for sure. I mean, yeah, all of this is happening in the face of in Indonesia, which is let's say roughly 50% of the global market. They're ramping up production, not down. So yeah, it's a difficult combination of events from a supply demand perspective. That's for sure.
Yeah. So takeaway here is carbon's up, aluminum kind of in the middle, right? Support, nickel prices down, I guess. No, up but down, right?
Yeah, I'd say it really is kind of, yeah, carbon prices ripping higher, aluminum mostly sideways with a little sprinkle of optimism, and then nickel prices are looking like they're going to be under pressure for a bit. And yeah, we could have done the entire podcast in 30 seconds and just summarized that
one. But I wouldn't get a chance to ask here the irrelevant questions. No. So I've been chomping at the bit to get to this question because I want to give kudos to a viewer, Chris, who managed to get a question that touches each one of you. So I don't know who to ask, but this is great. So I'm just throw it out there, and it's a wordy question. So whoever wants to take it, take it. Is there any pricing advantage at this time to pulling stainless, carbon, aluminum long products from European mills versus U.S. mills? And if so,
that to Jeff.
Okay, there's that one. And if so, is that price partially favorable due to the looming freight recession? And will any upcoming potential tariffs outweigh that current benefit? So, like I said, it touched all of you. So,
yep,
have at it.
I can take a shot at that. So, the short answer is yes, but you mentioned the tariffs, and the reason I say that is something we didn't get to on the call, but 232 is being discussed with the EU right now. They had this meeting, GSA summit, and they were trying to form, US was hoping to form what they considered the climate club. And that climate club, in order to be a member, you had to be a responsible citizen in terms of pollution. You had to have stricter environmental protocols, not subsidizing and not leading to oversupply. So the EU wanted the US to do away with Section 232 completely because they're under TRQs, which are tariff rate quotas right now. That was supposed to expire in October. They did not come to an agreement. Now, failing to come to an agreement means that the 10% on aluminum and 25% on carbon kicks back in January across the board. And that's on $10 billion worth of goods coming from Europe into the United States. Now, do I think that's going to happen? No, I think the default will be the TRQ remains in place and it gets extended. I don't think they'll just revert back to, okay, 10 aluminum, 15 or 25 carbon. But having said that, you'd really have to look at each product on an individual basis to see. You also have this 15-country aluminum extrusion review that's going on, and a number of the mills are around 50 to 100% potential tariff that's going to be put on that. So would I say aluminum? Maybe not. Stainless in Europe, they've been on a bit of a tear restocking stainless to try and get ahead of what they thought was pending increases and everything. So stainless was doing quite well. And carbon, I just haven't seen a lot of competitive numbers on carbon coming into North America. So hopefully that touches on that question for you.
Yeah. No, nicely done. Elizabeth, anything you want to add?
No, I was just going to say, generally speaking, with tariffs, freight's not the deciding factor. At least it's not anymore. We're not seeing $16,000 a container. So it's usually just a bonus, the icing, the cherry on the cake, not what makes the decision.
Makes sense.
Just because I like to hear myself talk, I'll chime in with one small if we do, in fact, if the futures numbers are anywhere near accurate and we do see carbon price, hot roll prices go towards 1,000 or above 1,000, Jeff's answer, I think, changes a little bit, which is at that point, imports do begin to look attractive. And at which point I do believe they would come into the United States in a fairly large way. So that's the only thing I'll add.
This question kind of consolidates a few, it speaks to the nickel side of things you were talking about, Nick. With nickel decreasing, why have we not seen stainless prices come down at the same level? So nickel, right, is a contributing factor to the stainless surcharge. I guess what's the correlation or the relation between the two?
Yeah, so we are seeing surcharges coming down. So one of the big components of stainless pricing is coming down, because that's just a formulaic piece of the equation of nickel feeds into the surcharge calculation that feeds into the price, or at least a piece of the price of stainless. So there is a relationship there that should be directly linear. With regards to base prices, which is essentially the cost of making stainless steel for a domestic mill, I would say my gut says we probably will see a little pressure year over year going into 2024 for base pricing relative to 2023. But I will caveat that answer by saying there are really only primarily two big stainless steel producers in the United States. And right, wrong, or indifferent, that does give them a little bit more pricing power to not have to adjust base pricing every single day as new factors arise. That's not exactly a great answer, but I think it's an accurate answer, which is in some ways there are just so few players in the space on the supply side domestically that they tend to be a little slower to make movements up or down.
Makes sense. Okay. Well, unfortunately, we're right up against the hour here. Great conversation. I think I learned a lot about really what drives the freight and imports, and how what's going on with the pricing across the board. So this is kind of where we leave with a closing thought, and I'd like to start with you, Elizabeth. We're heading here. We're now in November. I guess what's your key takeaway, and what does the freight market look like in regards to metal prices, metal supply, and what you would metals market for the remainder of the year?
Yeah, so I don't think that it's the same thing, right? Freight's not going to be driving the cost of metal either, just because it is so low, and there's a lot of excess capacity out there. So even though mills and metal distributors have their own carrier partners or their own fleets, I don't think that's really going to be a major factor in your delivered costs or you getting those goods. Certainly, we haven't seen the seasonality that we normally do with retailers ramping up inventory into the holiday season. So that's also another kind of signal that things aren't going so well for the freight market, and probably also for the larger economy. So we've really got to be looking that there's got to be an upturn in Q1 towards the end. Otherwise, things are going to get dire for freight carriers.
And as you mentioned earlier, Ryerson has its own fleet, and so the freight recession really isn't a big factor into what we're doing.
Yeah. And for most mills or metal distributors, it's not as big a factor for us.
Makes sense. Okay. Jeff, how about you? Closing thoughts. What are your key takeaways here that viewers should leave with?
I think key takeaways for import are we're already into Q2 right now. So as far as what's going to happen for year end, I mean, if you look at hot rolled productions late January, cold rolled and coated is February, March. You're talking about April arrival into the Gulf. So we're already well into 2024 on the import side of things.
Already into the new year. How's it
already
looking?
In. Prices are up.
And Nick, before I give you a closing thought here, reminder: the replay will be on Ryerson's YouTube channel If not tomorrow, then by Monday. We just, if you didn't get a chance to attend our Metal 101 session earlier, well, I guess it's last month already in October. That is also on our YouTube channel. Check it out. We did some analogies between making steel and making a cake, which I thought was pretty interesting, among other things, but very informational content. Nick, I'll leave it to you to close it up.
Hey, it's November 2nd. We're getting right in the thick of holiday season. I don't have anything on the metals or economy side at this point, but I hope everyone, whether you're internal or Ryerson or you're a customer of ours, hope everyone has a great holiday and holiday season. And we'll be back next month. Looking forward to it.
Thanks, everybody. Appreciate it.
Thanks.
Bye.